Good afternoon, folks. And here we are at the end of another very tumultuous week. Markets continue to be guided by the progress or the happenings of the war in the Gulf. And based on whether the Strait of Hormuz is open or closed or whatever be the status on that, markets have been reacting because it's so sensitive to oil prices. And this week, though, I think the Indian markets were impacted not just by the conflict, but by also major happenings in the HDFC Bank. And I think this was one event that caused our markets to behave differently from the rest of the world. Well, if one takes the entire week into account, I think Indian markets have been relatively all right as compared to other global markets. We're about 0.5% up versus many other markets make down, but anywhere between 1% and to 3%. Today itself, for the Japanese markets, fell by about 3%. It's a pretty steep fall for a large market. It all depends on where the war heads next. If the supply of oil continues, then I think we should be better off. I think the news has been coming through. And as we have been speaking earlier, I think it is going to be the rest of the world putting pressure on the warring nations to somehow to de-escalate and keep the oil flowing. And that is what is going to end the war eventually. Though it looks like it goes on to a different level day on day with the bombing and targeting of oil facilities, water facilities, etc. But I hope that comes to an end. So the ET Wealth today has a training map of the different asset classes, which every week they come up with another trend map, and this time it is of asset classes, which is gold, silver, debt, government securities, mid-cap equities, all-cap equity, and large-cap equity. Okay, and in spite of the connections that have happened, the top of the chart is gold at 20.2%. Mind you, this is on the newspaper up to 10th March, and post that the calendar year-to-date return on gold has come down from 20% to just 10%. It is half already. In spite of which, it remains at the top of the chart because large cap equity is down 11% since January 1st. And so you have these other two extremes. While gold may be up 10% in India, you'd be surprised to know it's maybe just 0.5% up in Australia and about 6.5% up in the US. So why does it vary from country to country? It varies from country to country based on the relative strength of those currencies. Now you will observe that the Indian rupee has been depreciating versus the dollar and we import gold. So the price of gold in Indian rupees goes up relative to the US dollar because our currency has depreciated. And much of the difference in prices can be attributed to currency appreciation or depreciation. The Australian dollar has appreciated versus the US dollar, and hence gold has not really gone up in the Australian dollar terms, only 0.5% up in calendar year to date. And the euro is the gold is up 8%, and some of it can be attributed to the fact that the euro actually depreciated versus dollar this year, while all of last year it had appreciated. This year it depreciated a bit. If you're living in Australia, you may not have much use for gold as a currency hedge. But if you're in India and we are in a depreciating currency, then gold is very useful as a hedge against imported inflation, against currency depreciation, apart from the uncertainty factor that we will always speaking about rental users. An interesting article by Srikanth here, and the headline says, homing in on NRI property trap. So what Srikanth is saying is, NRIs generally get attracted to buying houses and property in India, but it actually could be a trap. Why? So why is it a bad idea, she asks. First of all, many NRIs buy a house in India with the intention of returning to live there someday. By the time they actually do return, it could be many years in between. And by then, obsolescence has set up. It's become an old building, it has an old design, it has old fixtures, it has old amenities. And the entire point of having a buying a property to come back and live in goes for a toss, because by then they would probably sell it off and want to buy a new apartment or a new property which is in tune with their current lifestyle and the current trends. So, well, there was no point in buying that property. Second, they may have their families living in those apartments, and every now and then they would want to upgrade the house or the home as an obligation. Somebody better off wants to have their and ensure that their family back here is living well, and this is expensive, upgrading the house regularly, and eventually that becomes a cost which is not recoverable. If the house in the it goes to somebody else, well, it's still not recoverable. So many find it awkward to stake a claim to the houses they have funded. It turns out to be an investment that yields no rent or return, but further commitments for upgradation and possible loss of ownership of the asset. Okay, so this is again another reason why Uma Srikanth thinks it's a bad idea. Third, many of these properties are funded by foreign currency converted to rupees. And as we were just speaking, the Indian rupee continuously depreciates against other currencies, other large currencies. So this results in a further value problem, as the rupee has depreciated against the dollar over the years. So most of these investments, she says, happen mostly due to pressure from family and parents to invest in property back home as a safety net or a hook for possible return. But as years roll by, the NRIs seldom return, more so as the children grow older and begin to work and study abroad. And as their families in turn grow abroad, the chance for them coming back and using this apartment or the house here is very negligible. And hence it's a waste of time. And it's a pain for NRIs to manage properties from so far away. Many of them don't engage property management services because they think that there's a tiny part of their overall wealth and they don't pay attention. But remains a millstone, remains a pain. And for every repair, they end up paying a large premium, the distance premium, because they have to manage it from elsewhere. And eventually, when they pass away, the next generation doesn't even want to bother about it. It's too painful for them to come here and manage any transmission of the asset. So overall, returns they never see, as Uma also writes here, that they never end up seeing the return from their property because it's just left. Okay, they rarely sell it. But it's more of a trap than a utility, more of a trap than an investment. And that is what Uma Srikanth would like us to guard against. There's an article here on the benefits of diversification. It says 3 crashes, 7 portfolios, 1 lesson. Diversification works. I agree with the headline that diversification works, but the article goes into analyzing 7 different kinds of portfolios, basically with different mixes of equity, debt, and gold, and how they would have reacted in different crises over the last few years, right from 2000, the dot-com bust, then you have the Fed rate hikes and inflation hikes, the global financial crisis, then various slowdowns in the economy, the China slowdown and commodity crash, and COVID, and so on, different scenarios, and how markets fell and how the portfolios react. So the number of complicated bubble charts, etc., that we have here in this article generally are measuring how long did it take for the portfolios to bounce back, how much did they return a year from the bottom, or 3 years from the bottom, or 5 years from the bottom. Okay, so well, they do bounce back. That's a fact. I mean, markets go back and your portfolios bounce back. Drawdown is much lesser if you are debt heavy, and drawdowns are much worse if you are equity heavy. Okay, that's also something to know. I would rather have wished that the author here analyzed how markets behaved, how portfolios behave, different kinds of portfolios behave from the peak of the market before the crash, and how they performed. Even if you had bought at a peak, how did they perform? Yes, the drawdown impacts risk tolerance. Okay, and lesser your risk tolerance, the more you're likely to panic. When you have a steep drawdown like 60% during global financial crisis in 2008, or the COVID crash of 38%, Though during the COVID crash and the global financial crisis, markets bounced back much quicker because you had governments across the world lending support, social support, financial institution support, liquidity support. They ensured all this was there, and hence markets bounced back rapidly, unlike, say, the dot-com bust, where it took a much longer time for markets to bounce back. Okay, so yes, diversification helps, but what is also important is not just diversification across asset classes, but within the equity asset class, how are you diversified or are you concentrated? Okay, and that could determine how your portfolio behaves. A concentrated equity portfolio can behave horribly in drawdowns. Overly diversified portfolio will not go up too much when markets go up. So a fine balance is what is important. While we are on this topic of diversification, we also see how portfolios can crash with markets. When markets crash, we don't know when they'll crash. And sometimes the drawdowns can be severe. If you happen to be having on goal for that money at that time, you'd not be too happy because your corpus would have been diminished if you happen to be equity heavy. Generally, in an accumulation phase of your portfolio, you are equity heavy because that is what makes your money in the long run more than anything else. But when there's a market drawdown, your corpus at that point of time diminishes. What do? That was the money you had set apart for that goal. Which is why it is so important that well ahead of the goal, you de-risk your portfolio. It could be a year or year and a half or 2 years before the goal, you should begin to make it equity light or zero equity. So that whatever capital that you have grown, you're preserving the capital which is meant to be used for that goal. Whether it is education or wedding or retirement. Okay. Generally what happens is, if it is some goal before retirement, you still have some way to make up for that. Or you can always draw from your retirement corpus and make up for the shortfall in the education corpus. But when it comes to retirement, there's nothing else after that. You're not earning more money after that. Right? So it leaves no scope for you to make up for that diminution. Which is why, especially when it comes to retirement, one has to de-risk the portfolio in advance. Okay, please bear that in mind. Then I would like to come to an interview with Anand Shah, who manages ICICI Prudential's PMS division, and says market sentiment remains fragile, but India's long-term play is intact. He says every time we've seen a crisis, the nearest one being the Ukraine-Russia war, markets tend to factor in quickly the adverse impacts and then understand that everything cannot be extrapolated, and they recover. Okay, and he says same here. We are just 20 days into the war, and we still have to really manage the shock of the war. And once things are better and more predictable, markets will recover. Okay, and that is the gist. And he says, of course, the Indian long-term fundamental remains strong, the way it remained the day before the war began. Okay, and then it is the oil crisis. We need to get through this, and then I think we should be better off. So long-term investors really do not have anything to worry about. And we've spoken that if it is possible, you should rebalance your portfolios, taking advantage of the existing valuations. It says OpenAI's bid to allow X-rated talk is freaking out its own advisors. I'm happy that it's freaking out somebody. Okay, the rest of the world should also be freaking out if you have an artificial intelligence engine being used for adult and X-rated conversations. I think it's horrible. Everybody knows that it's a large industry, and if you're out there to make money, this is the way to make money. But we do not want AI engines to get into this. It's going to destroy what little fabric we have left in society. It only goes to show that these AI engines, these companies could very dangerously determine the course of how communities progress in the world. And there needs to be a regulator, I think. Otherwise, in their greed for money, things would just go out of control. So I think more than employment or loss of employment, I'm worried how these guys would use uh, the AI engines, the chat GPT is a word, for the wrong purposes, entirely the wrong purpose. Uh, I hope, I hope somebody puts a lid on this. The problem is nobody has control. These guys could become so powerful they would control the rest of the world, and those are what nightmares are made of. Let's pray and hope that it doesn't go that way, and governments will step in and regulate these guys. That's all for this week, folks. Thank you. Have a great weekend.